Howdy, Jacob here. Today we're looking at the company AutoZone. Get in the zone. AutoZone. Wow. Specialty retail industry, 48 billion market cap on 56 billion enterprise value. So they do have a little bit of net debt here. This company is infamous for their share repurchases. Them and MVR are the two companies where their revenue and their earning power, free cash flow, have probably gone up maybe anywhere from 5 to 15 times over the last 30 years, but their stock price has gone up over 100-fold due to their ability to buy back shares at a very cheap price and to consistently be buying back shares. Because when you do that, you essentially get the return of the business, and they have both had great businesses. And so you're looking at a company that has gone up 100 times since mid 1990s, and their their earnings and their free cash flow have nowhere near gone up that much, but through their ability to buy back shares, they have their stock price has. So you're looking at a very consistent company here. The latest year-over-year growth we see is 2.4%, the greatest of 15.8%. So we're going to be looking at very consistent growth, which is a positive, pretty consistent gross and operating margin. So really, again, when you buy back shares, it's just going to depend on the price of the stock, whether it's a great investment or not. But again, if you dollar cost average, you're really just going to get to the make the return of the business, and that's why we see their earnings per share go up so much greater than their revenue. The revenue is not even doubled, and yet the earnings per share is well over tripled, and is over 4 times greater, in fact. Return on invested capital, 40%, absolutely amazing. But again, you have to remember when you buy back shares, it does deflate your denominator, which of your ROIC calculation, and inflates the return on invested capital figure. And through buying back shares for so long, they actually have a negative return on equity. So we see that they have 20 billion in total liabilities, 15 billion in assets, and 7.6 billion long-term debt. That 7.6 billion long-term debt is still not very substantial in relation to their 5-year average free cash flow. You're looking at about just over 3 years of their free cash flow to pay off that debt. So the debt figure really is not that big of a concern. But again, it's going to get to a point if they never buy back, never pay down that debt, they just refinance. It's going to get to a point that gets a little crazy in the future unless they're able to build their free cash flow along with it. And so if your free cash flow, if you double your debt, but you double your free cash flow, then obviously in relation to your free cash flow, the debt figure stays the same. But good production of free cash flow here. Capital expenditures are going up through a little bit of reinvestment. But again, like I said, majority of their money is going towards buying back shares. So let's start with some assumptions here. Revenue growth side, I think I'd probably be pretty comfortable with 5%, 4%. Let's do 5%. I mean, the company, I'm doing a PE this high because I think the company is, one, very consistent, and two, they have a track record that is very impressive. And so for those two reasons, I think that it does deserve a premium above the market. For margins here, I think I'd be pretty comfortable going with 15 and 16 with a share change of 1% would be about $480 million. And let's say 80% of their free cash flow goes towards that repurchasing. So you're looking at about $2 billion going towards it. So $2 billion would be about 4% to offset stock-based compensation as well. So let's say we do that assumption. And with the assumptions we have here, we're predicting that the stock price needs to fall. We're not predicting anything. We're saying the stock price needs to fall 27% before you get a return of 15% with these assumptions. So not predicting where the stock price is going, whatever, I don't care. But what I do care about is buying a company at the right price, and 27% drop before you get the return I'm looking for here is honestly not a terrible, not terribly priced. And so we'll see once it drops more to do more research in it. But for now, just waiting until it gets you a more attractive price. But fantastic company. They've done historically so well with repurchasing shares. I definitely want to own it. But again, everything is these type of businesses are calculated at the present value of earnings and free cash flow. And I just don't think you're getting quite the cash flow yet to get the return I'm looking for. But hopefully you enjoy the video of yours.